The high level for me, if you look kind of at debt markets around the world, there's about $300 trillion of global debt. And I put this chart in the chat here, Nick, you can put it on the video. And about 100 trillion of that debt globally is in emerging markets. And so these countries generally have, much more kind of variable GDP growth, as well as challenges ultimately with their currencies. Most of this debt recently, and this has been a trend for a number of years lately, has been issued in their local currency rather than in US dollars. And so as the currency devalues, it becomes more challenging for an investor to make a return if they're investing from a US dollar denominated base or some other dollar denominated base. So look, the emerging markets are heavily saddled. I mean, some of these countries have over 300% or 250% debt to GDP. And what's really gone on recently is that many of them, as net importers of energy and food, are going to struggle to make the stuff they need to make at home or to feed their people at home because of the rising inflation that's been happening around the world from the producers of those goods and services, of those goods. And so to import those goods is more expensive. That makes it more challenging for people to be able to afford food, to be able to afford energy. This is part of what we're seeing happening in Sri Lanka. What's compounding this is we have rising inflation in the US. So as we've been talking about a lot, the Fed's been raising interest rates here in the US, which means that you can now buy treasuries that yield 3%. If you're an investor around the world, where else are you going to put your money except US treasuries in a market like this? You want to buy 3% yield in US dollars versus, getting 10% yield in, some currency denominated account, some currency denominated bond in a country you don't really know well or trust as much as the United States. And so as a result, a lot of dollars are moving out of emerging market debt into US debt, and the price of that debt has collapsed. And so we've seen in the last couple of months a decline of emerging market debt of about 20%. This makes it harder for those countries to issue new debt to fund things, and it's creating this really challenging spiral that may ultimately lead to defaults. Those defaults absolutely have a trickling effect, because if one country starts to default and you're an investor in emerging market debt, you're going to say, hey, wait a second, this I just took a huge loss in this position. You're going to start to sell off other emerging market debt. And then it becomes harder for those countries to raise more debt and fund themselves, and it can cause a cataclysmic spiral. So, it's a really scary scenario we're wading into now. And I think we really hope that the US starts to taper interest rates and we find some stability in these markets over the next couple of months, because it's not just a food and energy crisis, it's also a humanitarian crisis, and ultimately could lead to a global financial crisis.
And in fact, the bond issuance
it's highly complex, but it's something that folks are tracking very closely here.